61%. That is the share of Americans who now say they do not want a data center built near them. According to polling from the Annenberg Public Policy Center, the same research found something stranger. Given the choice, voters would rather live next to a nuclear power plant than an AI data center. For 3 years, none of that mattered to markets. This week, it suddenly did. Chip stocks sold off, the hottest trade on Wall Street rolled over, and CNBC's Jim Cramer, one of the AI boom's loudest cheerleaders, told his audience the AI trade is, quote, currently broken. Today on The Current, the 3 cracks that appeared in a single week, the trillion-dollar cushion the government slid under the bond market, and the one number arriving Wednesday night that will decide whether this was a stumble or the top. To understand what broke, you need to see what was working. The AI trade was never complicated. It rested on 3 assumptions. 1. Every dollar of AI spending is good news, so when Microsoft or Meta raised CapEx plans, you bought. 2. The build-out has unlimited runway because demand for compute only grows. 3. Nobody will stop it, not regulators, not politicians, not the neighbors. Those 3 beliefs turned a handful of companies into the entire stock market's engine. Nvidia alone is now worth more than $5 trillion, the largest weight in the S&P 500 at about 7.8% of the whole index. The top 7 names are roughly a third of it. If you own an index fund, you own this trade, whether you meant to or not. This week, each of the 3 assumptions took a visible hit, one by one. Start with the tape itself. Last Thursday brought a broad sell-off, driven by a sharp rise in bond yields, the same AI-flavored interest rate story we covered in the $3 trillion episode. Monday, the pressure moved to chips. Micron dropped 5.8% in a day, on reports the White House might let Apple buy memory chips from Chinese suppliers. AMD fell more than 3%, Broadcom more than 2%. In Seoul, Samsung announced it would hand investors up to $79 billion, one of the largest shareholder returns in history, and its stock fell 8.7% anyway. And where did the money go? Into Coca-Cola, into Johnson & Johnson. Cramer called it exactly that, a Coca-Cola J&J market, and his own investing club started trimming AI names, beginning with a big cut to Broadcom. When profits rotate from the future to the boring, someone's story has stopped selling. Assumption 2, unlimited runway, ran into Texas. On August the 3rd, Governor Greg Abbott ordered the state's grid operator to pause new data center connections until every project passes a comprehensive audit. The number behind the order is almost hard to say out loud. ERCOT, the Texas grid, is sitting on roughly 474 gigawatts of connection requests. That is more than 5 times the highest demand the Texas grid has ever recorded, and about 90% of it is data centers. Regulators will now audit up to 300 projects, checking whether they even answered the state survey on water and power use. Texas is the most build anything pro-energy state in America. It courted this industry for years. When Texas is the one saying slow down, prove your numbers, the industry's frictionless map of the future has a hole in it. Assumption 3, nobody will stop it, died in the polling data. In just the first 3 months of 2026, local opposition blocked or delayed 75 data center projects worth about $130 billion in planned construction, according to Data Center Watch. That opposition is bipartisan. 69% of Democrats oppose a nearby data center, and so do 54% of Republicans. Now it is campaign material. In Texas, an attack ad opens with someone typing into a chatbot, "Why is my electric bill going up?" In Ohio, an ad blames a sitting senator for data centers it calls a total scam. The Republican Senate Campaign Committee has warned candidates that data centers are a sleeper issue for the entire midterm cycle. Political strategists in both parties say it is reshaping races for the House, the Senate, and governor's mansions. The build-out is now on the ballot. Why did this become a voting issue so fast? Because it is one of the only AI stories with a receipt attached. Most people never see a training cluster, but everyone sees their electric bill, and in the regions where data centers cluster, those bills have been climbing double digits. We walked the mechanics in our power grid episode. Data centers bid in the same capacity auctions your utility does, and record auction prices flow straight onto household statements. Add the jobs anxiety, the water use, and the fact that a hyperscaler can outbid any town for anything, and you get a rare species. An issue that makes suburban Democrats and rural Republicans angry at the same building. Politicians do not create waves like this, they surf them. And the market finally noticed the wave was pointed at its favorite trade. Let's be precise about what broken means, because it does not mean the companies stopped making money. A trade is a story plus a marginal buyer. As long as the next investor believes AI spending equals future profit, every CapEx announcement pushes prices up. The trade breaks when that next buyer hesitates, and it does not require bad earnings to happen. It requires doubt. This week, the doubt had 3 names: Yields, Texas, and the Ballot box. None of them change what Nvidia will report on Wednesday. All of them change what investors are willing to pay for it. That is why a market can rotate into soda and Band-Aids while AI revenues are still growing at historic rates. Prices move on the second derivative of belief, and belief, unlike revenue, can reverse in a week. Now here is the strange part. While Wall Street wobbled, the machine itself did not slow at all. The Big Four hyperscalers remain on track to deploy more than $650 billion on AI infrastructure this year, per Bloomberg NEF, which also notes the widest gap on record between announced spending and actually energized megawatts. The money is committed, the concrete and grid connections are years behind. OpenAI just cut the price of its flagship model by 80% to 20 cents per million tokens, while ChatGPT crossed roughly 1 billion weekly users. Nvidia is reportedly in talks to invest in Perplexity at a valuation above $30 billion, a company whose annualized revenue tripled to $750 million this year. Alibaba is raising $10 billion for AI, with a mega share sale investors are lukewarm on. The industry is accelerating into the doubt. One side of this week is wrong. There was one more tell this week, and it came from Washington. On Monday, markets sank in early trading, then cut their losses on a single report. The Treasury Department may tap its roughly $1 trillion general account, essentially the government's checking account, to fund buybacks of its own bonds. Read that twice. The same AI and deficit borrowing wave that pushed 30-year yields to 25-year highs is now uncomfortable enough that the government is exploring ways to cushion its own bond market. For stocks, it worked for an afternoon, but it tells you where the pressure really lives. The AI build-out is being financed in the bond market is creaking, and the buyer of last resort is warming up. When the safety net comes out, it is rarely because the acrobats feel confident. All of it funnels into Wednesday. Nvidia reports earnings after the close on August 26th. Wall Street expects roughly $92 billion of revenue for the quarter, nearly double the $46.7 billion from a year ago, and about $2.09 in earnings per share. But the beat is almost beside the point. What matters is guidance. Analysts want to hear something like $102 billion for next quarter, and any hint that hyperscalers are hesitating, that the politics are slowing orders, that the runway is shorter than the story, lands on the biggest single weight in the S&P 500. One company, 7.8% of the index, reporting into a market that spent a week rehearsing its doubts. Your retirement account will move on this print. That is not a metaphor, that is arithmetic, and it is exactly what concentration means. So is the trade dead? History says booms almost never die from one bad week, and this one has survived sell-offs before, each time rescued by an earnings print. But history also says booms rarely die from earnings at all. They die when the financing turns or the politics turn, and this week both flickered at once. Yields at generational highs, $1 trillion cushion under the bond market, and 61% of the country telling pollsters no. Watch 3 things from here: Nvidia's guidance Wednesday, what the Texas audit actually does to that 474 gigawatt queue, and whether the campaign ads keep working, because policy follows ads that work. This is education, not financial advice, so do your own research. We will be back Thursday, the morning after the print, to count what actually broke and what did not. Subscribe so you don't miss it.